we are an educational site, we still give you strategies and different tools and techniques to enhance and elevate your trading. Because what we really want to do is we want to empower you so that you're not relying on an outside source, so that you're not simply taking your signals blindly from some site or some educator, so that you really understand the process behind the trade. Now, to give you a little background about myself, I've been trading for 37 years. I started on the floor of the Pacific Stock Exchange. So my background is in stocks. I was on the floor for 16 years, and 9 of those years I was a specialist. But ever since I left the floor in the mid-90s, I've virtually traded any market and every market available, from the stock market to the Forex markets to the E-mini market. So we educate people on all the things that I've accumulated in my 37 years of trading, and I pass them on to you so that hopefully we can shorten your learning curve and once again empower you with all the things that I've accumulated in roughly 37 years. So I present these webinars for FX Suite and hopefully to educate you and so that you'll be able to use all the things that I present for free. Today I'm going to speak about the 2 things you must do before each and every trade. And when I say must do, I really mean absolutely must do. And this is part 1 of a 2-part webinar series. I'll give the next presentation, I believe, next month. But this part 1 will really increase your odds for success, but you must do this prior to each and every trade. Now, before we begin, if you want to get a little bit more information about myself and about my company, Specialist Trading, I invite you to go to the microsite that FX Suite has put together for us. This is the link below in blue, as you see, and it's a little lengthy, so we've shortened it and abbreviated it. So as you see here, the link in yellow, the abbreviated link, is the one you should copy down. And I'll give this to you at the very end of the presentation as well. But if you click on that link, once you've copied it down, it will take you to the microsite where there's much more information about myself and also our sister site, which is ProTraderStrategies.com. This is the site where we basically promote and sell our individual strategies and courses. Specialist Trading is more of an educational site where you get the entire suite altogether. And as well, the microsite will feature information where you can get exclusive deals and special offers up to $500 off on many of our courses. So I invite you all to go to the microsite. Once again, I'll give you that link at the end of the presentation. It's a microsite that FX Suite has put together for us so you can get more information about it. All right, now before we begin, also we're required to show you this, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results with this one thing that you must do before each and every trade, and this is part 1 of this series. But please remember that we can in no way guarantee that any of the results I'm about to show you and share with you will be repeated in the future. So as you're taking a moment to view our disclaimer, another thing I'd like to mention also is that I love to take any of your questions, any of all of your questions, but I'd like to wait to the very end to answer them. So if you happen to have a question once we were going through this presentation, please write it down, and I promise I'll get to it at the very end. This won't be a real long presentation, so you'll be able to understand it in roughly about 20 minutes. And then we'll reserve the last 15 or so minutes for any questions, okay? So write them down, and I'll get to them at the very end, okay? All right, now, as I stated in the beginning, I've had roughly 37 years experience in trading. But, you know, a lot of people say, well, boy, if he's been trading that long, he must have been successful right from the very start. And that's not really true. I started out probably the way most of you started out, thinking that, you know, my eyes, you know, wide open, thinking I had the perfect plan and the perfect technique. But my first year, even as a specialist, even on the floor of the stock exchange, I struggled tremendously. I was taught all the conventional wisdom and probably all the things that you were taught and all the books and webinars or seminars I went to that told me what the right things were in order to be successful. And they would work for a while until they stopped working, and then I would give everything back that I just about made in the last, 2 or 3 months. So after a year of being a specialist, I had really no reward to show for it. I really thought that my life as a trader on the floor of the exchange wasn't going to be lasting long because I wasn't making any money. I was just breaking even, which was, to me, just, wasn't worth anything. And I had nothing to show for all my hard, work that I was putting into this. And I'm sure a lot of you are going through this as well. Right about this time, I came in contact with a few traders on the floor. These were specialists themselves. Now, a specialist doesn't mean that you're special. It means that you specialize in a certain number of stocks. So, in other words, if you wanted to buy or sell IBM or Apple, if it were on the floor, at that time, you would go up to the person who specializes in that stock. This is the person you can only buy or sell it from. That's where the name specialist comes from. It doesn't mean that you're a special trader, that you have this great insight. But a lot of people think that because you're a specialist and because you knew all about the stock and its volume and everything and of the company, that you were able to make money. But this wasn't the case with me. But at this time, I came in contact with a few mentors that were able to turn my way of trading around. They really basically showed me what I needed and what I didn't need. And all the things I had been taught, all the conventional wisdom that was supposed to be making me money, they said to simply throw that out the window, because if it was so good and if that was so valid, why wasn't it working? And they said that too many people put importance in these things, and there really is a lot of stuff out there that just doesn't work, but for some reason we think it will. So they told me to really simplify my trading, to simplify it, to only have maybe one indicator, to only trade one market at a time, to forget about news or just put it in its place, don't put as much concentration on news. And once I simplified my trading, I started to become more consistent, more successful. So this is what I teach to all of you in these presentations, as well as all my members and students at Specialist Trading, is that the road to consistency is paved with simplicity. So this is my goal, to teach you how to trade with the specialist edge, the edge that got me on the road to consistency, because that's really the true meaning of success. It's not about how much money you can make, because I know tons of traders that made millions of dollars in short periods of time. And I can basically say without a doubt that they've lost it all. So how successful is it if you can't hold on to it? The real meaning of success, in my opinion, over all these years is longevity, is being able to trade for 10, 20, 30, 40 years down the road, because you're always able to come back another day and trade. So that's what I try to instill in all my members, and what I try to instill in you with all these presentations I give for FX Street, is to trade with the specialist edge, which is rooted in simplicity. And it's really about a program you have that you give yourself that's designed for you and that you just repeat each and every day. I often state to my members, if you're trading correctly, it's extremely boring because you're just doing everything right. You just sit back and wait. It's comparable to fishing. All right. You don't need 20 or 30 screens in front of you. You don't need to be following 20 different chat rooms or trading rooms. You don't need to be watching every bit of news information. It's just too complicated. And if that's the way you trade, ask yourself, how's it working? How's it working for you now? Are you tremendously successful, or are you just barely breaking even, or are you losing money? I could almost say, guaranteed to say that you're not doing that well. So these things really aren't getting you any closer to where you want to be. Once you start stripping them away and sticking to things that have worked through time, that have stood the test of time, then you'll get on that road to consistency. Okay, I'm not going to promise all of my students and members that they're all going to be millionaires within a matter of 3 or 4 months, but I will promise you that you're really going to learn some solid, basic things that I can almost, really feel confident about that will take your trading to the next level. So this is what I try to teach in all my webinars, as well as to all my members of my site. So my goal is to teach you how to trade with the specialist edge, and I'm going to teach you some things today that are rooted in the specialist edge. Extremely simple, but powerful, as you'll see in just a moment. Here's what you're going to learn today. Remember, this is a 2-part series. I'll give you the second part next month. But in this first part, I'm going to give you a great edge, which is called the RPS method. Okay, it's a simple mathematical formula that you must calculate prior to the trade. This doesn't mean prior to each and every day. This means before you get a trade, before you pull the trigger, you must calculate this. Okay, you can't just simply jump in and blindly trade without using this calculation, the RPS method. And remember, it must be done before each and every trade. Now, what does it have to do with? Well, it has to do with position sizing. Okay, now why do we care about the position sizing? I know a lot of people say, well, it's proper money management to know your position sizing. Well, it goes much more than that. There's much more that has to be taken into consideration just because of money management. So let's go into detail, talk about some of the insights into position size. And one of the reasons why it's so important is that too many traders are undercapitalized. I know a lot of traders, regardless of the market, are trading with too small amounts of money. I mean, if you want to trade and hold positions overnight, regardless of what market, you should have an adequate amount of money. If you're trading the large currency pairs, the large lots, we feel you should have anywhere from $20,000 to $50,000. If you're trading the mini lots, well, then $2,000 to $5,000 or $2,000 to $10,000. But many people will be trading with $500 because they've been told on some site that they can trade for $100 to $200. you need at least $2,000 to $3,000 to begin trading if you're trading the mini lots, and to $20,000 to $50,000 if you're trading the large units. Now, it's wrong to use discretion when you're deciding on your position size. Okay, it's absolutely wrong. But this is probably the way 99% of all traders trade. They'll get an idea for a trade, or say they're in a chat room and someone suggests something, or they want to go long the British pound and the Australian dollar, and so they, boy, I'm going to buy 5 lots. You know, this is a great idea, and you just decide on how many lots or what your position size is at the very last moment. Why? Because you're using discretion. Or say you wake up and you feel real lucky and confident today, so you say you're gonna bet the house. Or you say you feel terrible and not so confident, you had a bad day, you keep your position size very low. Even though you've had a string of winners, you're just very scared that it's going to run out. Okay, you're using discretion, and this is not the way to decide on your position size. Once again, I know this firsthand because this is the way I used to trade. I'd have a great day, and I would bet the farm the next day because I thought, well, my luck's going to keep going. And I would have a terrible day, and I'd keep everything small. Or maybe I would bet the farm again so I could make it all back. So it was all a discretionary move. We want to take that component out of our position size. What we want to do is use a simple mathematical formula. This is the RPS. But remember, this must be used prior to every trade. So even if you get an idea about what you want to do, you can't pull the trigger until you calculate this RPS method. Why? Because it automatically decides how many shares or lots you're going to trade. Okay? If you're trading stocks, it'll tell you how many shares. If you're trading futures or the currency pairs, it'll tell you how many lots to trade. And so you'll know exactly going into the trade how much you should or should not be trading with. Remember, the specialist edge is by adding structure to your trading, you take the guesswork out of position size. And so this method, really what it basically does in a nutshell is it takes the guesswork out because we're adding structure, okay? By adding structure, what we mean is we're taking discretion out of the picture. All right, right, here's what you want to do. The first thing you want to do, as we said, we want to start out with an adequate amount of capital. We went over the parameters. What we feel, in our opinion, is the right amount of capital that you should have in order to trade. All right. Now, what you want to do is you want to risk only 2% of that trade, okay, on any trade. So in other words, let's say you have $10,000 to trade with. That's what you have in your account. 2% of that roughly is $200. So that's the most you will risk on any trade, 200%, as long as your account is roughly around 10,000. If it's less, if you only have 5,000, well, you only risk roughly 1%, $100. If you have 20,000, you'll risk roughly about $400. But that's the golden rule, 2%. Now, I know a lot of traders will trade 5, even 10%. Some traders trade less than that, trade with only 1% of their capital. I know I personally use roughly about 1% most of the time. Okay, so some traders use even less than that. It's up to you, but the benchmark would be 2%. So if you're trading roughly with an account that you know is honest, that's your real amount of money you can work with per trade, you only want to risk 2% of that. That's per trade. Okay. Now, conservative traders will include slippage or the spread included in that. So this is something you want to take into account as well. But just keep it around 2%, especially if you're just starting out. If you really feel you must go over that in order to trade it, I would say no more than 3, but that's really stretching it. If you're just a beginner or you've only been trading for a short amount of time, keep it at 2%. 1 would be even better. All right, so how do we apply the RPS? Okay, this is what we're going to be getting into today. This is what I want to make sure that everyone understands. So I just want to make sure no one is asking questions. Remember, if you have any questions, just wait till the very end and I'll go over everything again with you. But how do we apply this method? All right, so I'll go over the rules with you. You can write these down. I believe this presentation is being recorded by FX Street, so if you want to, you can see them about getting a recording of this particular presentation so that you can study it a little bit better. Here is the position sizing formula for the Forex markets. Rule number 1 is you want to determine the 2% risk amount of your capital. Remember, we just went over that right now. So if you have a $10,000 amount, you're roughly going to be risking $200. That's your 2%. Now you have to decide on stop placement. In other words, you have to know prior to going into the trade where you will be stopped out if you're wrong. Right? Too many traders go into a trade thinking that they're absolutely going to be right. Okay? How many times have you thought, oh my goodness, this is a great trade, This is where I'm getting out if I make money. But what about where you're going to get out if you lose money? Because, there's odds are you may lose on the trade. So you must know in advance where your stop is going to be and how much you will lose if you get stopped out with a loss. Now, this could be a recent low or a recent high, depending on what side of the trade you're on. Now, rule number 3 is if you're stopped out, what would be the total dollar amount lost per contract? So in other words, if you lose so many pips, what does that transfer over into a dollar amount per contract or per lot? Okay? Not if you were trading 5 or 10 units or if you're trading just one, but always figure it out just for per contract or per lot, what would be the dollar amount that you lost? Now, what you want to do is for rule number 4 is you divide your 2% dollar risk, let's say that was $200, by the amount of the total stopped out dollar loss, okay? And I'll show you this in a lot of detail and with a lot of graphs, so this will be a lot easier to understand. It won't be so wordy. But once you divide your 2% by the dollar loss, this will give you the size amount. So you'll round off to the nearest number for the proper position size. And it's that simple. Now, I know a lot of you may be saying, boy, I've got to do this before every trade. Sometimes I'll get a trade right, or an idea right after a news announcement comes out. Steve, how can I figure this out? Well, trust me. I've been doing this for some time, and we have students at Specialist Trading that have been trading for only a week or two that have figured out how to use this, and it can apply it, you just, without the aid of a calculator, can figure it out in their head in roughly about 10 seconds. So it's not that hard. With a little practice, you can do it and put it together very simply. All right, let's put together and see what this formula looks like, just abbreviated form. Remember, it's the RPS formula. R equals the 2% risk amount of your capital. P equals the pip dollar loss if you're stopped out, okay? And then lastly, S equals the size or number of lots to trade. So what we want to do is divide R by P, and this will give us S, or the size or the number of lots to trade. It's that simple, okay? Now let's put some actual numbers to this so we can figure this out on our own. Let's say, just to make things easy, we have a 100% hypothetical account. Okay, I know most of you probably don't have that. I don't have a $100,000 Forex account, so don't worry. But let's just say we have a $100,000 account to work with. All right? Now, we are only going to risk 2%. That's all we're going to risk, 2%. So, what is 2% of $100,000? R equals the 2% risk dollar amount of our capital. So that comes out to $2,000. So that means if we lose on that, any trade where our account is roughly $100,000, we can only lose $2,000 or less. We will never lose more than 2%, which at this time is $2,000. All right, now we figure out what P is. P is the pip dollar loss if we were stopped out. Well, in this particular trade, we had a 100 pip stop loss. So if we got stopped out, we would lose 100 pips. Now, what does that transfer over into dollars? Well, in this particular case, let's just say it transferred over into $1,000. All right, so P equals 1,000. So what we do is we divide R, which is 2,000, by P, which is 1,000, and 1,000 goes into 2,000 two times. So that is the number we can trade with. That's our lot. We can two contracts, two futures share lots, and that's it. That's what we can trade, two currency pair lots. You see how simple that is? Rather than say, well, boy, I have 100,000 to work with, I'm going to buy 10, or I'm going to sell 10 or 20. I have so much money I can use. That's not the way it works. You figure this out, put the RPS method together, and we'll tell you and automatically decide for you. Now, you see, this will change as your account size changes, as your risk parameters change as well. Your account size may be much smaller, and your risk may be maybe 0.5% or maybe 1%. So this will all change. Now, as your account size grows and your risk parameters change, this number will change as well. And for instance, let's look at something a little bit more down to earth. Let's look at a $20,000 account, all right? So what is 2% of $20,000? Well, R equals the 2% risk dollar amount of capital, and that comes out to $400. So we know with a $20,000 account, basically, using this formula, we're only going to risk per trade $400. That's the most we'll lose per trade. All right, now in this particular setup, P equals the pip dollar loss if we're stopped out. So once again, we're going to lose 100 pips. That's how much we would lose if we're stopped out. And 100 pips will come out to roughly $1,000. So R equals 400, P equals 1,000. So how many times does 1,000 go into 400? Well, it really doesn't. In fact, it's coming up with a negative number of negative 0.40. So if we round that out, it doesn't even equal 1. So basically, with this risk parameter and with this account size and using a 100 pip stop, we cannot take the trade. So this automatically decides for us, using these parameters, we can't take the trade. Now, this doesn't mean where you'll say, well, okay, well, I'll risk 10% on this particular trade. That'll give me more money to work with. This is not something that you'll change in order to get yourself to trade. You have to stick to this formula, all right? So using this same formula each and every day, well, in this particular setup, you wouldn't be able to take the trade. And who knows? It may have been a blessing in disguise. Maybe the trade didn't work out. Now, let's look at some actual examples here. Once again, we'll start with a $100,000 account just to, get you familiar with how this works. This is an older chart in the euro dollar, and then I'll show you something that happened just a few days ago. But this was an actual signal, one of our signals. I believe this is strategy number 5, one of our most popular and probably the most consistent, successful strategies we have. A while back ago, last year, this gave a buy signal in the euro dollar. All right, let's say we had a hypothetical $100,000 account. All right. First thing we want to do is figure out the parameters for risk. We're only going to risk 2% as our benchmark. So what is 2% of 100,000? Well, obviously, it's $2,000. So R equals 2,000. All right, now we have to figure out the structure of the trade. So where would we enter? Well, according to our parameters, we would enter right here. All right, this is where we enter. And more importantly than our entry, where would we get stopped out? Let's say this was a terrible trade. Say we got stopped out the very next day. Well, here's where we're placing our stop. Once we enter the trade, our stop would be right here. All right, so we would enter the trade, the euro dollar, right here. And if we were wrong, we get stopped out right here. Now, what does that transfer over into pips? Well, that comes out to 200 pips. So we're risking 200 pips. Okay, but we still need to know, what does 200 pips equal in a dollar amount for one lot? Well, 200 pips in the euro dollar will come out to $2,000. So we now know that R is 2% of our account, which is 2,000, and P equals the dollar amount if we were stopped out with one lot. Okay, so R equals P. So what we want to do is divide R by P, or in other words, how many times does 2,000 go into 2,000? Obviously, it only goes in one time, so that means we can only trade one lot. So with our account size and with these parameters, we would have had a nice trade trading one lot. We would have made roughly about 200 pips in basically just less than a week. All right, now let's look at a recent trade. This is an actual trade that our members of Specialist Trading were alerted to. We send out alerts to all of our members, but remember also, we're not just blindly giving you signals and you don't understand why we should go long or short and you just take them. These are actual strategies that we teach you how to look for. We give you different parameters if you want to trade aggressively or conservatively. But this was actually one of our trades that happened just a week ago in the British pound to go long. This was strategy number 6. All right, now $50,000 account. That's a little bit more like it. This is what we use at Specialist Trading, a $50,000 account. Now, this is a chart in the British pound. As you see here, this was just less than 3 weeks ago, actually, the very beginning, the first week of September. Now, we had a really nice setup using our strategy number 6, which is an indicator-based strategy, using one indicator that's very simple to look at and very easy to figure out. So, according to the strategy in the British pound, we first have to find out what our 2% is of our account. So, $50,000, all right. What is 2%? Well, that's $1,000. So that's all we are going to be risking. We're only going to be risking $1,000 on this trade. So R equals 1,000. Now let's look at the structure of what the actual trade was. We told our members to enter at 1.5592. All right, this is where you're going to be entering on the next day. And we had to also tell them where the stop was. The stop is at 1.5505. All right, so that's our basic structure without giving the rules away too much. That's our basic structure of the trade, an actual trade we took. But what does that transfer over into pips? In other words, let's say we were totally wrong. Let's say the British pound did not go up. Well, we would get stopped out at 55.05. That would turn out to be 87 pips. Now, if we were trading one lot, of the British pound according to these parameters, we would lose 87 pips, and that transfers over into $870. So we have R, which equals 1,000. We have P, which equals 870. So we divide R by P. All right, 870 goes into 1,000 roughly one time. So we have one lot to work with. So a good portion of our members who had an account size like this, we're trading the full contract. Remember, we're giving examples with the full unit, the full currency pair. You can, trade the mini lots as well and trade a lot more and a lot more currency pairs. But we had a very, very nice trade. And this was actually up until yesterday, as you can see here. The trade worked very well. Now, we had exit parameters as well, but we also teach you how to stay in the trade longer if you like. It's all up to you. We don't tell you how to trade. We teach you ways in which to trade. And then it's up to you to become a part of the process and decide whether you want to stay in longer, if you want to be more conservative. But we teach you ways in which to exit at a standard generic exit or to simply stay in the trade longer. It's up to you. So this is a great trade. This worked out fantastic. Once again, a real world signal that was generated to all of our members that had strategy number 6. We issued an alert going out the night before to go long the British pound at this point. Now, what if someone wants to use a different stop? What if you said, well, Steve, before I took the trade, I thought maybe this needed a little bit more room. What if I entered? Many times you enter to a trade, then it goes the opposite direction. You get stopped out, and then it goes back in the direction you wanted to go in the first place. I'm sure this is very familiar with a lot of people. So you got to opt for a different stop. So we still have a $50,000 account. Once again, this is just assuming we're trading the large currency pairs. You could also apply this to the mini contract or what else? Even I believe they're micro units as well. But it's all relative. So you just scale back on this percentage. The main thing is you're looking just for a percentage or whatever your account size is. So the R would still equal the same. We're only going to risk $1,000. Now, before we were going to place our stop right here below the setup bar. But let's say you wanted to give it a little bit more room. You didn't want to enter it, have it come down, and then go back up again. So you want to place your stop below this lowest low here. It looked like we made a real nice bottom here. So you place your stop right there, which would be at 54.25, just below that low, okay? That's fine. There's nothing wrong with that. We teach our members that they can use different stops. In fact, we give you upwards of 6 to 7 different stop placement levels based on different parameters. So this is one of them, going off the lowest low, the last roughly 10 bars. So let's say you decided to use that one, all right? Well, if you got stopped out, how many pips would you lose? According to these new parameters, you would lose 167 pips. Now, if you had one lot, what would that transfer into a dollar loss? That would transfer into 1670, okay, trading one lot or one contract. So R equals 1,000, P equals 1670. If 1670 doesn't go into 1,000, which it doesn't, well, then it's basically telling you can't take the trade because it doesn't divide into there. And you don't want to round off to that because it's just not worth it to meet the parameters. So with that much risk that you're giving yourself, you really can't trade this trade, even though it was nice and profitable. You're risking far too much with your account size according to these parameters. Now, remember, once again, this does not give you the option to say, well, I'll change the parameters. Now, risk should equal 5%, and that way I'll be able to trade. No, that's not the way it's meant to be. You should stick to a format, and remember, your benchmark should be 2% or less. And you can decide where to place your stop after that, but you should stick to that same format, regardless if you're trading the large currency pairs or the small micro or mini units. All right, remember, the main thing we're trying to stress to all of you is that you should never use discretion when deciding on position size. And if there's one thing you get out of this, regardless of technical things like, well, what about my account size? Well, you never want to use discretion. That really is one of the things that leads to Forex traders being unsuccessful. All right? There are so many things that will lead to that, and this is one of them. This is one of the major things. You may have a great trading plan, a great strategy, or a great way of trading, but your position size is ruining it for you because you have no plan. You put tons of energy and work into deciding a plan on how to trade, but actually no plan on deciding on how much position size you should have. So you should be giving just as much equal energy and effort onto deciding your position size. And this is what the RPS method does. I use this each and every trade, and it has helped me and saved me tons of money. Sometimes it will keep me out of trades that were winners, but oftentimes it will keep me out of trades that were losers. So I thank it because of my account size and the parameters. All right? Remember, always make sure your trading is adequately capitalized. Let's say you like to trade 3 or 4 units at a time. Well, this will actually not give you the freedom to do that. And this is why we're adding structure, because possibly you shouldn't be trading that many contracts. And a lot of people will say, well, what if, I want to be trading multiple units? Well, only trade, especially in the beginning when you're using this, only trade one currency pair at a time. Remember, as I stated in the beginning of the presentation, I used to trade with 20 screens in front of me. I used to look at each and every bit of news information and try to decipher what it meant in order to decide on what to trade. At the time, we didn't have trading rooms or chat rooms, but what we had were newsletters and trading gurus, and I subscribed to all of them. And I was listening to all of them to help me decide what to do. So ultimately, my trading was so overcomplicated. I was trading far too many markets, too many time frames. My mentor said, Steve, simplify your trading. So I simplified things where I was only trading maybe one thing at a time. So that's what we're trying to say. Simplify your trading. Instead of trading 4 or 5 currency pairs, trade one, especially in the beginning, and you'll get on that road to consistency. Okay? Now, the RPS method is a simple mathematical formula that must be used prior to every trade. Why? Because it automatically decides how many lots to trade. It takes the discretion out, so you don't have to think about it. You don't have to wake up that morning and say, boy, I really like the British pound, but how many should I buy here? Or, boy, I had a terrible day yesterday. Maybe I should buy a lot so I can make it all back. You never want to get into that mindset. You want it to be automatically decided for you by using the RPS method. The specialist edge, once again, is by adding structure, you take the guesswork out of position size. Okay, here's what you learned today. We gave you the first edge in this 2-part series. The RPS method must be calculated before each and every trade. Okay, and you know the rules. It's pretty simple. When I first read it, I'm sure a lot of you, your eyes were spinning, saying, boy, I can't calculate this. It's too complicated. But after you've seen it now, it's like much easier than you thought. And I'm sure with a little practice, you'll be able to put it together very quickly. This is usually reserved just for the members of Specialist Trading. Well, we're sharing this with you. Once again, I like to give all of my attendees free information. I know a lot of people, the minute they start talking, all they start doing is trying to sell their products. We're really trying to educate all of our members, all the people here at FX Street and all of our members. So what we really try to do is give you something free with the webinars and presentations. And I think this is a tremendously powerful tool that you can use for free. Now you know all the rules. It's no different from what I use on a daily basis. Now, this was part 1. What you learned today was the RPS method. And once again, this must be done before each and every trade. Now, the title of this 2-part series are the 2 things that must be done before each and every trade. So next week, or next month, we're going to show you the second most powerful thing you must do before each and every trade. Okay? You have the first one, and we will show you the second one in next month's presentation. Now, just to spend a few moments on what we do, here is the homepage of my website, Specialist Trading. As you can see, we have courses for not only Forex trading, but for stock trading and e-mini trading as well. Each one of these courses comes with upwards of 10 different trading strategies. Strategies for intraday trading, strategies for position, for swing trading, for longer term types of trading. But what we provide here is the full enchilada, if you will. These are our premier packages, and they can run thousands of dollars. They're expensive because you're paying for roughly 10 strategies, and plus it's more of a mentorship where I'm really with you there all the time, and I'm teaching you how to implement all of these different strategies that best suit your personal needs. What we've done here is we've created a sister site, Pro Trader Strategies, which sells our individual strategies. And this is probably one of our most consistent and most popular strategies. This is Forex strategy number 5, swing trader strategy number 5. It's produced real-world results of 158% gains in 3 years. Okay, this is just trading one unit. It's not compounding anything. And when we say real-world, we're talking about all the signals that we generate and we alert our members. So in other words, we're not going back 10, 20 years and seeing how well this would have done. We're only interested in actual signals that we provide our members. So if you become a member 3 years ago, your account will be up nearly 160% in just 3 years, okay? Now, just to show you how well this strategy works, these are a couple of actual examples of trades that happened within the last 3 months. As you see here, this is the Australian dollar. As it was going lower, we had some really nice signals to go short in July and in August. And then just a week ago, we had a very nice signal to go up. Now, these are the standard generic exits. You could use different exits that we teach you. You could stay in the trade longer. You could stay in the trade short if you like. The British pound, these are also signals that we received in the British pound in August, as you see here, and then on the 6th, which was just a few weeks ago, to go long in the British pound, as you see. Once again, standard generic exits. You could stay in much longer if you would have liked and had some really nice gains, or stay in for a shorter time and just gotten in quickly in and out. These are actual real world trades with strategy number 5. The night before you're supposed to enter these trades, we send you alerts telling you where to enter, where to exit, where to place your stop, and using the most standard, basic, generic rules. So you should know these rules after a couple of weeks once you're in the course, and so you won't rely on the alerts, and you'll be able to figure them out for yourself. We teach you all of this. So once again, real world results, meaning these are real gains produced from members that took our signals, 158% in 3 years. With this individual course, you get detailed instruction. We tell you all the entries, exits, and stops. 1 year of trade signal alerts. 1 year of weekly trading lessons. You get a PDF of all the rules so you can print them out and study them at your own pace. And then lastly, you get my personal email address so you can contact me with any questions. Now, as you saw here, just looking at those past examples in the Australian dollar and the British pound, the tremendous gains you would have made trading one lot. Well, even at $5.95, this is extremely, extremely inexpensive, but we've discounted this for all of our FX Street attendees down to even more, down to $3.45, okay? So this is for a limited time only. It's extremely, extremely discounted, so I would urge you to take advantage of that. If you really want to get more information, remember, you can contact us at protraderstrategies.com. That's where we market our individual strategies, as we just shared with you. Or you can contact our senior VP of trade research. That's Don Jans at protraderstrategies.com. And you can call us directly at area code 310-492-5393. Now, I want to thank you all for waiting to ask any questions. If you'll bear with me, I'll open up the question and answer box, and we can answer any questions you may have. I'd like to go back just to the beginning, just to see if anyone asked anything prior to it starting. And I see that Mr. Bird asks, what about if we have multiple trades open at once? How can we handle 2% rule? This is a great question. Remember, I basically went over this and I stated this is the way I used to trade with multiple trades going on all the time. I had far too many trades. What we teach our members is just to stick basically with 1, maybe 2 trades at the most at a time. That's why we only urge you to trade 1 strategy at a time, which will give you signals and not to overlap, okay? So this is why we do this. This is why we make sure that we want to be keeping things as simple as possible. Now, the same person also said, wouldn't it be the risk of 1,000 divided by 1670 equal 0.60 lots? Yes, it would, but it's just 0.60 is closer to the median point than it is to 1 out. So that, if you're using a judgment call on that, it really isn't justifying trading 1 lot with those parameters. If you wanted to, you could, but we would we teach you about this in the course, and we would strongly urge against it. So that's a good point, but we would rather see something as 0.75 and over, showing you that you're rounding it off to the largest number, okay? Let's see. The next question is, looking at it the other way, can this be used to determine where your stop should be based on your risk and how many lots you want to trade? Yes, it could, but in all our courses, we don't let an outside source determine where the risk is. In other words, we don't let an outside source such as the RPS method or money management determine the risk. We let the market, because the way we define where to place our stop is, where is it wrong to be in the trade? In other words, where is the market telling us it's wrong to be long or it's wrong to be short? We don't look at the RPS method telling us where to place our stop, or we don't look at the news telling us, or things of that nature. So we always listen to the market. That's one of the tenets we use in our courses. It's learn how to listen to the market. Too many people listen to outside sources. You're always listening to some guy on TV. You're listening to someone in a chat room or a trading room. You're listening to some guru who's telling you have to buy or sell here. What we do is we say, listen, the most important thing is to learn how to listen to the market, because that's where you should be taking all of your signals from, not from an outside source. The reason why so many traders lose is because they give their power away and trust these things. The best thing you should be trusting is the market, and we teach you how to trust the market and how to listen to it. So in a way, I'm sure you could use this to define your risk and where to place your stop, but what we would say is let the market tell you. We share with you different stop placement levels, and then you can choose which one that meets your needs, okay? So I hope that answers your question. Next question is it okay to have a small amount and risk more than 2%? Well, if you are just beginning, we always tell our members to risk no more than 2%. And if you've been trading for a while, let's say you've been trading, as long as I have, 37 years, I think the most I've ever risked is 3%. So if I don't risk that much, I don't think you should be risking more than 3%. That's the extreme. Once you start going past those parameters, you leave yourself open to some really large string of losses. Because if you go into a large drawdown, if you go, and that happens, that will happen with every strategy, every type of trading system. If you go into a slump, well, 3% will turn out to be 5%, and you'll try to make it back, and pretty soon you've wiped out your whole account. Better to stick with the standard benchmark of 2%. Now, a lot of people say, especially my beginning students, will say, well, Steve, this keeps me out of a lot of trades. Well, yes, it does. So that's telling you that either your account size is too small, or you're trading a market where it's too much risk. You shouldn't be trading that. Wait for something that has smaller risk that will fit your parameters. Okay, these are all things that you should take into consideration. Just because a trade is there doesn't mean you should be taking it. Okay, so when we say that, this is really a great tool for giving you structure. As you see here, a lot of people will say, well, structure is more, it sounds more like you're giving me restrictions. Well, you could look at it that way, but it's really giving you defined structure, just the way, when you play a game, say you play the game of basketball, well, there are certain rules, certain things that must be followed in order to score points and in order to create fouls. Someone could say, well, those are all restrictions. No, they're not. They're just the rules of the game. And if you play them with a sound strategy, you should be able to win. It's the same thing with adding structure to your trading. Okay? Zaid is asking, well, listening to the market, is that price action? Yes, most of it is price action and base. So we're not looking at, remember, we're just looking at what the market is telling us. Okay? If you listen to some trading guru in a chat room, a trading room, that's not the market. That's his opinion. Okay? If you're listening to somebody on TV, on some guru or some component of these things, who's been trading for a while and is telling you what the British pound is going to do, well, that's his opinion once again. I have initiated signals not based on what my opinion is, off of what the market has told me. So in other words, if the market, after all these years of learning how to listen to it, the British pound says to me it's going higher, well, then I just jump on board. I don't put in my personal beliefs about, well, economically, it's not really good to go long and there's going to be some news announcement, which makes me want to sit on the sidelines because that could be bad. You see, that's my own personal beliefs coming in. I don't take those into consideration. If the market by price action and by chart and by a few small indicators that we use, common indicators, are telling us it wants to go higher, well, then we just jump on board. If it's telling us it wants to go lower, well, then we jump on board to the short side. That's it. Okay? Next question is, what is a good account size to start with? Well, remember, it all depends on how long you've been trading and what market you're trading. And, do you want to trade the large units, the large contracts of the currency pairs? As we stated, you should have anywhere from 25,000 to 50,000. Okay? If you're trading micro or mini units, 2,000 to 10,000. Okay? This is my opinion. This is not a trade decision. It's just my opinion. But what I've seen through over the years. Okay? And what is the minimum size you would recommend to have once one is trading for a few years successful? Well, that's subjective. There's no way to say, everyone is different. After a few years, I've seen successful traders have hundreds of thousands of dollars, and they still only risk 1%, maybe half of 1%. So it's all different. Over a few successful years, there are still traders that have maybe only $5,000 account, and they're trading micro units. So it's all relative. It's all subjective to what the trader wants. So you can't try to fit everyone into the same box. It doesn't work that way. A minimum of 100,000 or 5,000. Well, I would say if you're trading the smaller units, I would say roughly $2,000 to $10,000. Okay. Like you mentioned, you have 50,000 as a specialist. Well, yes, but I trade different markets. I'm also using that account to trade stocks. When I trade stocks, I don't go into the Forex markets. I keep everything separate. But I think one of the big pitfalls that many traders go and fall into is that they say, well, someone does this, so this means I should do this. That's not the way it works. In all my experience, I find that will lead you down a road of disaster. You have to find what works for you. That's why I don't believe in trading rooms or chat rooms, because they're a crutch. After a while, you will start trying to mimic the traders or traders in that room. And that's a recipe for disaster. Remember, as I stated in the very opening sequence of this presentation, we are an educational company. We're not just someone that blindly gives you signals to follow. We want to educate you so that you can understand the process and then decide for yourself. We want to put the power in your hand. If you want to take the trade, you can take it. If not, if you want to trade a smaller size, if you want to trade with a smaller account size, it's all up to you. But the point is, don't ever, ever try to mimic what someone else does. I can give you a short example really quickly. About 10 years ago, before I started my site, I had a student that wanted to learn how to trade from me. So I had them actually come and sit with me in my office and watch everything I did for a couple of weeks until they finally understood perfectly how to trade a certain market. After that, I made sure that they understood it, and they did, and they went on their way. And I contacted them about a couple of weeks later, and because it should have been a great week. I had a really nice week trading. I made a lot of money, and so I wanted to see they should have done the same or at least had some success. When I talked to the trader, he said he hadn't made any money. In fact, he lost money. And I said, how could you have done that? We're trading the exact same way. And his response was, I just couldn't pull the trigger. I just felt uncomfortable. Ultimately, we came to the conclusion that he was trying to mimic me, and that really wasn't his style. After weeks of figuring it out, it turns out that he was more of a investor type of mindset. In other words, he didn't like to be in trades for a short amount of time. He actually liked to hold positions longer. So he was trying to mimic me, but that wasn't his mindset. He liked to hold things for a much longer time frame. So that's why so many traders lose money, is that they're out of sync because they think, well, someone else did this, so I should do this. And that's really a recipe for disaster. It's a crutch. That's why I don't believe in chat rooms or trading rooms, because you'll turn that into a way in which to copy. You have to find your own way. That's why we educate you and give you all the things I've learned in 37 years, and then we help you put it together so that it meets your needs. That's really, in my opinion, the true path to success. Now, my mentors didn't allow me to copy the way they traded. They just showed me the way, and then I figured out the direction on my own. Okay, so I hope that makes sense. And yes, I use the same structure for stocks and for the E-mini as well. So it doesn't really matter what market you're trading. Should a beginner buy a few of your strategies or do the full Forex trading course? Well, I would actually say, once again, I'm not a salesperson. I'm a trader, first of all. I started this to actually give education, not just to making money. I make more money trading than I do from my website. So I don't want anyone to spend more money than they have to. Our full course is a lot of money. It runs anywhere from $2,500 up to $5,000 or $6,000. All right. So I would suggest, if you're a beginner, just do an individual course. Now, if you're going to say, well, which is the best individual course? I think the deal that we shared with you, the strategy number 5, which I just showed you, that produced 158% in 3 years off real signals. I don't think you can go wrong with that, in my opinion. And for such a discounted price, $345 is a steal with FX Street. So I would take advantage of that. Okay, that's what I would suggest if you're a beginner. I don't want someone to spend more money than they have to. Keep your, trading as simple as possible. Spend as little money as possible. Don't join everything and spend tons of money. At the beginning, keep your cost to a minimum. And $345 is a very small price to pay for such a great, powerful strategy, in my opinion. Okay, so I hope that answers your question. Remember, go to our microsite that I provided for you. We shared with you the link there. It should be on this as well, and I'm sure the good people at FX Street will share that with you again. I believe they have it on this chat site here. And also, if you have any questions, you can contact our VP of trading signals. This is Don Jans at ProTraderStrategies.com. You can call us directly at 310-492-5393. I want to thank all the people at FX Street for giving me the opportunity to speak and give these presentations. Remember, this is a two-part series. We will be giving you the second most important thing that you must be doing before each and every trade in our next series, okay? I want to thank you all for attending. Remember, if you want to take advantage of that great discounted deal, you must do that and go to the either call us up, call this number, or go to that microsite, okay? It's a great, great strategy, had some great signals. Thank you so much for attending. I look forward to seeing you next week, and best of luck trading. Bye-bye.